Good afternoon, ladies and gentlemen. A very warm welcome to everyone who's watching Business Today television at this point of time where the markets really don't know where to go. You see an early morning bounce, but that bounce gets sold into. Successive selling pressure is coming across the board on mid caps and small caps, and it's creating anxiety in the minds of retail investors, especially those who have their SIPs continuing in mutual funds. At this point of hour, only a few select large cap stocks are doing well, and you see selling pressure across the board, whether it's small caps, mid caps, whether it's sectorally looking weak in defense, except for a couple of places where long side trade is hiding in a few metal stocks like National Aluminium, Hind Copper, public sector banks such as Bank of Baroda, Canara Bank, PNB, SBI, and to some extent AU Bank, AB Capital, L&T Finance. All these stocks are the ones where some amount of green is seen on a weekly basis, but across the board, ladies and gentlemen, there is very heavy selling pressure. To discuss this in a lot more, to throw some light where we are headed to, what to do and where to put in money, to withdraw or to continue. We are now joined by Mr. Dheeraj Relli, MD and CEO of HDFC Securities. Namaste Dheeraj ji, a very warm welcome. I'll come straight to the point. What is happening in the markets? Why are mid caps and small caps in such sad state of affairs when anything and everything that was possible from the side of the government has been done?
So there's nothing wrong in macro environment. There are no steps lagging from the government side. Earlier they were pushing the capex. Last year or so they've started to focusing on the consumption side with the revision of direct taxes and also on the GST side. So to that extent, whatever government could do, you're right, they have done that. But markets by and large are the slaves of earnings. And in fact, from last 1 year or so, we at our brokerage house, HDFC Securities, we've been always advising our investors that, look, you should be skewed towards the large cap because valuation in the mid and small cap have been frothy and the earning growth trajectory is also looking weak. But I can give you a good news here, though there are significant pains in the portfolio of most of the individual investors, most of the domestic institutional investors also, because that's where they receive the money and that's where they receive the mandate to invest in. But having said that, I think the pain is at the fag end. Now, if someone have to make money, I think mid caps and selected small cap will do better from here onwards for next 12 to 18 months time. We are at the fag end of the correction. This correction is more driven by the valuation and earning growth trajectory. Quarter 2 was good and showing some green shoots and promise. So we are getting turned sanguine and neutral, from neutral to sanguine on mid caps and small cap.
Okay. One good thing, Dheeraj ji, that has happened in the 7-8 months that have gone by, that successively retail investors have made their faith known in small caps and mid caps via the strong SIP numbers that are coming in. You think in the first week, in the first quarter of calendar 2026, this faith will be repaid by the market, especially in the mid cap and small cap space?
It's time to continue to stay invested in the mid cap and small cap. Markets do give these kind of pains in the different cycles, and those who have been in the markets for 2, 3, 4 decades, they know that these kind of cycles do come in the market where you have a lower earning growth and the price correction and the time correction do happen. I think we are at, as I just said, that we are at the fag end of price and time correction. So to that extent, I think they should continue. more in the mid cap and small cap. I know it's a contrarian call to what you would be getting from most of the other speakers, but we believe that we are seeing green shoots. We are seeing increase in the domestic activity post GST, revision of slabs. We have seen more incremental activity, and we believe that this will continue with low inflation, with macros are good, with interest rates are coming down, with infusion of liquidity, with RBI efforts. I think I don't see any challenge from a domestic front. Of course, we have a geopolitical issues that are still having an overhang on us. We are still seeing obtuse inflation in large economies like US
Correct.
and expecting a 25 basis point cut in the upcoming policy, but they're still grappling with the same, and also more to do with India specific. I think markets are waiting for the tariff deal to go through, and that's creating some kind of an uncertainty in the market at this juncture.
I think that is a fair assessment, that the lack of a deal is one of the swords that is hanging on the head of the Indian market. Let us see what progress is made. There is a US trade delegation in India which is discussing the nitty-gritties. Let's hope sane sense prevails, but yes, that lack I accept. Dheeraj, at this point of hour, how do you see the rupee impacting negatively on the market? A falling rupee, of course, is something that our foreign friends don't like.
Yeah, I think foreign friends do not like, and foreign portfolio investors to that extent have been proven right by selling and taking out money from Indian market, because in dollar terms Indian markets haven't performed, and they have got a better performance in their home market in US and also in Japan and China. So to that extent I think they are better off in taking out money from Indian markets, but this can't last for long, and my take is that the era of rupee depreciation is also at the fag end. I don't see a significant rupee depreciation happening from here onwards, and you will be surprised in the midterm, 2 to 3 years terms, we might start seeing some appreciation in the rupee also. And current depreciation cycle, I think RBI was comfortable with the larger volatility band, and they have not intervened, and to that extent I think to some sector it has been beneficial also, like metals have been beneficiaries of the rupee depreciation. IT sector is a beneficiary of rupee depreciation, also for pharma sector also. So some of the sectors, yes, and however the export oriented companies are having double whammy, in the sense that on one side they are seeing the benefit, but on the other side they are having a tariff deal hanging over their head, as you rightly articulated. But when it comes to the importers, I think that's where we are having a significant pain, and that's hurting their margins.
Okay. What is your advice to the thousands of ultra HNI investors that are a part of HDFC Securities? How are they moving their money?
See, look, this year have been actually good for those HNIs and those investors who have followed asset allocation to the T, who have invested into silver or gold, those small portion of their allocation, but still, could able to invest in that and continue to stay invested. They got the benefit that their portfolios are looking better than the portfolios that were skewed towards only equities, and particularly those were skewed towards the mid and small cap. So we've always been advocating at our level that customers should do a proper financial planning and then look forward to their asset allocation and continue to do the rebalancing of the asset allocation. So some of the investors who have invested in gold and silver are happy. We were aggressively pitching sovereign gold bond as a product in last few years since the time it has been launched, and many of our investors have accumulated that big time, and since it's a 8-year scheme, so they have all invested and now reaping in the benefit of the long-term investment in the gold. Silver, people were late to take the exposure, but many of them have taken the exposure, and today again it's at all-time high level. So whoever has taken have proved to be right. We've also advised some of our investors with a moderate risk profile to move towards the balance funds. To that extent, also they have been better off. Only very aggressive investors who were really taking more who were more adventurous and had more was seeking more thrills in the mid cap and small cap are the one who are really struggling, and there we are having active conversations with them because they are very vulnerable at this stage. Some of them have not seen this kind of corrections in their lifetime because they have been investors only for last few years only in the market. So that's where they have a lot of pain, and they are very vulnerable and jittery, and that's where we are having active conversation and engagement with them to explain them that these are the cycles and one has to bellwether the volatility and stay invested in the quality counters.
Dheeraj, please let me allow me to take this conversation a little forward when you talk about jittery and vulnerable investors. I presume these are folks who have a large percentage of their portfolios in mid-cap, small-cap funds or mid-cap, small-cap stocks. Am I right?
Absolutely. There are many customers who were seeking alpha through either mutual fund or PMS route, or even by venturing into the direct equity and skewed towards the mid cap and small cap. They were all looking forward for a higher return. Their expectations were very high, though many industry stalwarts have been talking about moderating the expectations, but the new investors have high expectations, and through your medium I would want to actually bring in the caution even now also those who have been investing on the metals and side to moderate and taper off their expectations. Gold and silver are not going to give them a 60 or 100% kind of returns going forward, so it is important to moderate their expectations.
धीरज जी, आप बहुत ही पते की बात कर रहे हैं. Now what about all those investors who have gone aggressively into mid cap, small cap space, but were fortunate to go through funds, because you have a fund manager who will do the grunge work in finding out potential winners and weeding out those stocks that may not perform. So do you think the cycle will reinflate for mid cap and small cap funds?
See, I'm very clear on that Q2 earnings were better. Valuation in overall, when we look at mid cap and small cap, is still higher, and I won't say it's in a euphoria phase. It has corrected, but it's still on a higher side. So that's where one has to be very, very selective. When you enter into stocks at a higher valuation, and if you go wrong in terms of your results, market punish you severely. That's what we are witnessing currently. So the problem is that not that most of these companies are not good companies and they don't have right management and right intent. The problem is that investors were chasing them at the wrong valuations. If you chase them at a higher valuation, and even if for a 1 or 2 quarter you see a moderation in the earnings, and that's where markets punish them severely, and that's what has been happening. But that's almost over. Maybe another quarter or so pain will remain, but after that we'll see 2026. I am predicting that mid caps and small caps will do better in 2026.
Okay. Let me just come back to a thought that you had just very briefly discussed, which was the balanced space. You are asking a lot of investors to move into balanced funds. Could you please explain the logic behind this choice?
No, not now. See, this is something we did a year ago or 18 months ago when we saw that there is a froth in the valuation. and that's where people with the moderate profile, we told them to have a higher allocation on the balance fund, because mostly balance funds invest in the large caps, and they also take the exposure in the high quality debt papers. And that's where we are seeing rate, when the inverse relationship of interest
Yes.
rate and the prices, and we knew that their price, the interest rates will come down, and we've been proved right, because we've seen 125 basis point correction and liquidity infusion and CRR correction from RBI. To that extent, 10-year yield and prices have increased and yields have come down. So that way, all balance funds have done well. So when it was the story 12 months, 18 months ago, not now. At this juncture, I think you will not have a significant upside in the bond side. So it's time to stay invested and more skewed towards the equities for long term, whether it's large cap, small cap, or multi cap. I think it is. This depends on the risk appetite, time horizon of the investors.
Uh, Dheeraj, for those entering the market now, somebody who's joined a job, is very keen to build wealth, looks at mutual funds, looks at Dalal Street with starry eyes. In hindsight, in the experience that you have collected over 3 decades, and especially over the last 15 months, what would your advice be?
I think there is no substitute for staggered investing. That's given. Anybody and everyone, whoever has their own doubt on the staggered investing, I would, clearly shun that, and I would say that, look, most of Indians are mass affluent customers and have regular income flows. The only way they can participate in a riskier asset class like equity is to staggered investing in the form of SIPs. One can do weekly, monthly, daily SIP. That's something, how paranoid you about the volatility, you can choose your options. But I think monthly and fortnightly SIPs are good enough. Don't need to go beyond that. So that's one method of investing. I would suggest those who are particularly investing for the first time to still go for a portfolio that are skewed towards the large cap, rather than straight away venturing into thematic funds or a small cap and mid cap fund, because these funds may have a higher volatility. But if you have a 10-year horizon, if you're a young 22, 25-year-old, 10, 15, 20-year horizon, I think a right allocation in a multi-cap fund will be good for them. And if you are venturing into the direct equity on your own, be very selective. There is no need for you to go with the non-quality names. You must only invest in high quality name recommended by your the stockbroker, who have high quality research, because that's where they add significant value, and you can't do that job on your own. It's like self medication, and you will create more issues than you will solve more problems.
Fair point. Dheeraj, it is always said that hindsight is an exact science, and the market teaches you some of the best lessons when it remains either sideways or starts to fall. We hope your sage advice, especially the last one, for newcomers and those who want to make sensible wealth in the market will be applied, and we hope for patience across the board, so that all of us might ride through this painful journey, which is necessary and essential, that the markets are showing us for the moment. Thank you for your time, and this is a promise that you have made before the show opened, that we will be discussing the model portfolio of HDFC Securities in terms of where fresh money should be deployed. We look forward to that show as well.
Looking forward to it. Thank you. Thank you for having me.
That, ladies and gentlemen, was Mr. Dheeraj Relli, MD and CEO of HDFC Securities. Markets in the red, it's not looking good. Stay tuned to Business Day Television.